Hi there, welcome to Napier Invests. About 7 or 8 years ago, about 5 or 6 years after I started investing, I discovered a show on Sky Business called Your Money, Your Core. In fact, it turned into one of my favorite TV shows. And in this show, uh, two experts came together and they started talking about companies that were requested by viewers. And they started to, talk about whether they will buy, holds, or sells, that sort of thing. And the reason I really liked that was you got some really good insights from these experts, and you could get ideas to further expand your knowledge about companies on the ASX. Unfortunately, that show finished about 2 or 3 years ago. So there was this big hole in my TV viewing life. Fortunately, that hole has been filled recently in the past year by two TV, well, not sure if you can say TV shows. They're, we'll say live stream shows that have popped up. And the first one is from or on AusBiz. This is a streaming business channel that has popped up. I believe Sky Business has finished as an option to view. These are free to watch. That's the other great thing about this. Your Money, Your Call on Sky Business was not free. You had to be a Foxtel subscriber. But these are all free. You can watch these. I do think you might have to sign up, but you don't have to pay anything. So AusBiz is very similar to Your Money, Your Call. There's these experts that come on and talk about 10 stocks in a day. Actually, it's 11 stocks because there's always a stock of the day. And then they talk about 10 stocks that have been requested by viewers. There's also a hypothetical portfolio. And if both experts have a company as a buy, that company gets put into the portfolio. And then if both experts say a company is not a buy and the stock is in the portfolio, it gets taken out. So a lot of very familiar names if you did watch Your Money, Your Core: Gary Glover, Howard Coleman, Rudy, Gord Walker, Scott Phillips, Mark Moreland, Andrew Page, Ben Clark. So a great TV show. It is aired live at noon, so live streamed. But if you can't watch it live, you can watch it just like I do at a time that is convenient for you, or they do have podcasts of these shows. The other show that has recently popped up is in Spotty TV. This is a very similar setup to Your Money, Your Call and the Core on AusBiz. I think it's a little bit different. It's only one expert per show, only aired 3 times a week. It's hosted by Elio D'Amato, which is a name you should be familiar with if you do or did watch Your Money, Your Core. And some of the names on this show include Richard Hemming, Tony Lacantro, David Novak, Nick Raj, and Frank Watkins. Hopefully you do recognize some of those names. So these are two things that have really popped up over the past year. And the reason I love these shows is because not only do you get those insights, but you do get some ideas. So what I've decided to do is something similar with this video today. AusBiz and Spotty did give me the inspiration to begin this new video series, which I'll call Buy, Hold, and Sell. When I first thought up of this concept a few days ago, two names popped up, Spectre and Sayona, and then I realized both those names begin with S. So I thought the theme of this initial video should be stocks starting with S. So I'll be featuring 10 companies today, and every single company's name starts with S. Now, even though I am calling this video Buy, Hold, and Sell, this is not a recommendation for you to buy, hold, or sell any companies that I do talk about today. I'll be talking about whether these companies are buy, hold, or sell in regards to where they fit into my own personal investing strategies. For each of the 10 companies I'll be focusing or featuring today, I'll be looking at whether they fit into the two trading strategies or vesting strategies that I have employed over the past decade or longer. The first strategy is whether the company is a long-term buy and hold. This was the strategy I began with when I started my investing journey. I think a lot of investors are taught this, new investors are taught this. This is the only way to invest. You find a company you like, you think has a long-term potential, buy it and then hold it as long as possible. Over the last few years, I have developed a new strategy called the momentum and sentiment strategy, which is a little bit different than long-term buy and hold. I just look at the momentum and sentiment of the company because I do believe human psychology plays a massive role in the short to medium term movements in share prices. So I'll be looking at the charts of all 10 companies and seeing whether the share price is showing there is a potential buy there. So all 10 companies, we'll be looking at the charts, also talk about their financials, and just look at the overall business of the company and see if there's any headwinds or tailwinds behind it. Then I'll talk about whether the company fits into either being a long-term buy and hold or has some positive momentum and sentiment behind it. So it's a momentum and sentiment play. Potentially it fits into both categories. And then there's the flip side. Potentially the company doesn't fit into either. It's not a long-term buy and hold, and there's negative momentum and sentiment. And in those situations, maybe it's best just to stay clear of the company for the time being. First company on the agenda today is Sandfire. This is a copper and gold miner. They do have one mine, but they are trying to diversify their operations. Ticker code SFR, market cap $1.3 billion, and revenue and operational cash flow in the trailing 12 months were $663 million and $302 million respectively. So just based off those numbers, this company does look like there could be some good value there. Not only that, they actually have $464 million of cash and no debt. This was at the end of March. So if you calculate the enterprise value, it is less than $1 billion. And one of the metrics I love to use is enterprise value to operational cash flow. So you just divide the enterprise value by the operational cash flow and you get a number around 3. So that's suggesting there might be some good value there, because anything less than 5 in the enterprise value to operational cash flow is potential good value. However, in saying all of that, they do spend a lot of money on capital expenditure. So when you take capital expenditure away from the operating cash flow, you do get free cash flow, and the free cash flow is considerably less than $302 million, which makes sense because they are trying to develop more mines to diversify their operations. Now let's look at the chart here. So this is the 3-year weekly chart going back to around about May 2017. So actually it's about a 4-year chart. Now, we don't see any significant trends at play here. There are short-term trends. If we go back to 2017 and 2018, we did see the share price go from about $6 to a high of $9.50 in about a year. So that trend was there for less than a year. And right now, we might be seeing the same upwards trend in the share price. So there is some positive sentiment and momentum behind the share price right now with Sandfire. But just looking at this 4-year weekly chart, this is definitely not the buy and hold sort of company. In fact, I'll show you the next slide, which is the 15-year monthly chart. And you can definitely see why this company is not a buy and hold, particularly because it's a mining company. And in my opinion, there is no mining companies, or say very few mining companies out there that are a buy and hold. You only buy it when there's some positive momentum and sentiment behind there. And there is a little bit of momentum, a positive momentum and sentiment right now with Sandfire. And if you just look at the 15-year monthly chart here, you can see a massive rise in the share price in 2009 and 2010, when the share price went from 3 cents to a high of $8. That is the time to be holding this sort of company, but you don't want it to have bought into the company back then and just keep on holding, because the share price has just gone sideways since 2010. And that is actually reflected in the revenue growth, which is only at 2% per year over the past 5 years. So just looking at this monthly chart, definitely not a buy and hold. Just wait for this until there's some positive momentum and sentiment behind the share price. The other thing that's sort of interested me is we've seen a lot of positive run up in the copper prices, and that's not really reflected in the Sandfire share price until recently. So there must be some reason behind that. So otherwise, just by looking at this monthly chart, anytime the share price gets to below $5, particularly $4.50, that would be a buy. And anytime it gets above about $8, that would be a sell. Right now, the share price is nearer $8 than nearer this buy signal below $4.50. So if the share price got to around $6.25, just by looking at the weekly chart in the previous slide, that could be a good time to take a position. At this point in time, it's not a long-term buy and hold, and there, even though there is some positive momentum and sentiment behind the share price, it does look like the share price is moving towards its long-term high. So that would be a sell signal. So at this point in time, not interested in Sandfire as either a buy and hold or a positive momentum and sentiment play. Second company I want to talk about is Sayona Mining. This was a request from a viewer. Ticker code SYA, market cap just below $200 million, and no financials to speak about at this point in time, so no point lingering on that. This is all about potential, all about the story in regards to lithium. So they are a lithium mine, and they are developing a project in Quebec. They also have some tenements in the Pilbara region of WA, and I think that's all about gold and lithium. They also have agreements with Piedmont and Novonix, and because they have no financials, this is a pure speculative stock, and I think this is all about your opinion on lithium and lithium prices in the future. If you believe lithium prices will soar as the demand of lithium increases, as electric vehicles take off, maybe this is the company for you. I don't have that high conviction around future lithium prices, so this is definitely not the buy and hold company for me. This is all about momentum and sentiment, and you can see that with the share or the chart here with Sayona. This is the 4-year weekly chart. And if we go back to late period 2017, there was a little bit of a hype around lithium back then. You can see that with the share price of Sayona. It went from a low of about 1 cent to a high of about 10.5 cents in about 3 months. That was a 10-bagger in a very short period of time. But if you were a buy and hold sort of investor, you thought lithium was the potential of lithium was through the roof, you might have held through that down period, and you would have seen your holdings in this, or your value of your holdings in this company, fall off dramatically. In fact, the share price went from that high of 10.5 cents and then went back down to 1 cent, the original price it was before that bubble in 2017. The share price then consolidated 1 cent, and we saw a breakout in the share price again in Sayona towards the end of 2021 or start of 2021. Share price has gone from 1 cent to a current share price just below 5 cents. If the share price does go above 5 cents, that would be a breakout. We did see it get there a couple of times in the past, just recently, a few weeks ago, and then again towards the start of 2021. So that is a little bit of a resistance level right on 5 cents. So if I see the share price gets above 5 cents, that could be a good sentiment play, but I would not hold this personally for a long period of time because you just don't know when the sentiment of lithium could change. It could change just like that. Third company I want to speak about is Senatus. Their ticker code is SEN. Market cap $52 million, revenue $26.3 million, and that revenue actually has been growing at about 6% per year over the last 5 years. So you do want to see growth in revenue. That is one thing I do look for. It is growing slowly, but it is growing. And they were operational cash flow in the trailing 12 months of $300,000. This is a company I actually have owned in the past as a long-term buy and hold. However, the story slightly changed. I decided to sell out about 2 or 3 years ago when the share price was significantly higher than it is now. And that's the main thing. The share price has dropped. There is negative sentiment and momentum behind their company and share price, even though they're in the right space. So Senatus specialize in cybersecurity solutions from high-performance network encryption to secure file sharing, collaboration, and anti-malware. That sounds amazing, sounds awesome. However, the market is thinking complete opposite. We've seen a share price go down all the way to currently 4.8 cents. Last time it was this low was during the COVID-19 financial panic when the share price got down to 4 cents. So this is at historic lows for the company, negative sentiment and momentum. And even though I did sell out in a long-term buy and hold, there is still a lot of potential behind this company. They are growing revenue. They are operational cash flow positive. The enterprise value right now, they do have $13.8 million of cash and no debt. The enterprise value right now, about 38 million, is the lowest since 2013, when they had revenue of $6 million and were operational cash flow negative. So back then in 2013, lots more positive sentiment around the company. And right now they have better financial state. They have a better balance sheet, better financial numbers, yet they have the same valuation. And that's why this company is becoming more and more attractive to me. However, the one thing that's holding me back is just this negative momentum and sentiment. So I do believe this is a potential long-term buy and hold at these prices. However, the one thing holding me back is that negative momentum and sentiment. Fourth company I want to talk about today is Spectre. This is a company I do own as a long-term buy and hold. I'm not looking at selling this company at all. No matter what happens, this is for the long term. And the main reason I'm holding this for the long term is because the valuation of the company. So Spectre is a developer of security, surveillance, and warning solution. Current market cap is $7 million. When I bought, the market cap was around $4 billion, so it has grown. Revenue in the trailing 12 months, $4.2 million. It is growing. There was a bit of a pause in the growth of the revenue due to COVID-19, but that has been corrected. We'll talk about that in a second. Operational cash flow negative 0.7. Hopefully that's going to be corrected in a few years. And if it is corrected, if they do become operational cash flow positive, I do believe we're going to see the share price in this company absolutely take off, because market cap of $7 million for an operational cash flow company that is growing revenue is really low. They did release a financial update on June the 2nd, the day, one day previous to when I'm doing this video. And they did announce record revenue for May, and that month was, they did have positive EBITDA, and expected revenue for the fourth quarter of the financial year is $1.8 million. So just compare that $1.8 million for a quarter to the $4.2 million in the trailing 12 months. So they are growing revenues, and there is potential that revenues are starting to accelerate. Now let's look at the chart, a fairly ugly looking chart over the past 4 years. In fact, go back 4 years ago, the share price was between 40 and 50 cents. So hopefully no one who is watching this video has been a long-term holder of this company. Share price was in a well-defined downtrend from 2018 all the way to 2020. But over the past year, we have seen the share price consolidating, going sideways. And we've seen the three moving averages, the 50-week, 20-week, and the 10-week moving averages coming together. That is showing you the share price is consolidating. So what we need now is a positive financial announcement from the company. The most ideal positive announcement from the company would be they are operational cash flow positive. If that happens, we're going to see the share price really take off. So even though I am a long-term buy and hold person around this company, there is potential if we do see a breakout in the share price. Not only will this be a long-term buy and hold for me, we'll also see positive momentum and sentiment behind this company. At this point in time, we'll say the sentiment around this company is fairly neutral. This is just a potential long-term buy and hold. The fifth company I'm going to talk about today is Straker Translations, and that's probably a dead giveaway in regards to what they do. So Straker are an AI language services company. They have developed a hybrid translation platform that combines AI, machine learning, and crowdsourced pool of translators. Whenever I look at their ticker code, STJ, I just think of St. George. Market cap of 127 million, revenue of 29 million for the financial year 21, and operational cash flow for that year of negative 300,000. So they did release their financial year 21 results on the 25th of May. This is a New Zealand company, and New Zealand companies tend to release their financial year results in May. Now, the $29 million of revenue is in Australian dollars. They report in New Zealand dollars. So just keep that in mind as well. $29 million translates to $31 million in New Zealand, if I remember correctly. On the 2nd of June, they have done or announced a capital raising, and they're raising $20 million at $1.90, which is a little bit of a discount to the current share price of $2.33. The reason why the share price ran up on their full financial year 21 results on 25th of May, so the share price went from $1.80 to $2.33 in a very short period of time, was because of the guidance the company gave to their financial year 22 numbers. They are expecting $50 million of revenue for their financial year 22, which is up from $31 million, so significant growth, which has been helped by some acquisitions, but they're also expecting some good organic growth. They're also expecting higher gross margins, so that should help their operational cash flow and profitability. I also calculated their compound annual growth rate of revenues, which has been 30% since 2016. So this is a growing company, and a quickly growing company at that. Now let's look at the chart and talk about why I'm kicking myself for not taking position in this company way back in November, when I did get a really good buy signal. You can see the share price rose in 1 week from 90 cents to $1.45. That was on the back of an announcement with IBM. They were providing one language for IBM. Now they're providing translation services of 50 to 70 languages. So a significant deal with IBM. And that was the catalyst behind the re-rating in Straker's share price in that week, and then ongoing from that week as well. So in regards to my investing strategies, we get a tick in regards to momentum and sentiment. Definitely positive momentum and sentiment right now, just looking at the chart. Also get a tick in terms of whether this company is a long-term buy and hold. I believe it is. However, even though this company does get 2 ticks, I am not a current shareholder of this company. The next company I want to talk about is St Barbara. This is a gold producer, ticker code SBM. Very similar financials to Sandfire. Market cap 1.4 billion, revenue 824 million, an operational cash flow of 308 million. There is one difference between Sandfire and St Barbara. Sandfire has $420 million or so of net cash. St Barbara has $100 million cash and $100 million of debt, which means no net cash, which also means the enterprise value is equal to their markup. So that's one slight difference between the two companies. So if you were thinking, trying to decide which company to buy, if you had to make that decision, I'd probably lean more towards Sandfire just based off the cash on hand. However, St Barbara did release a financial year 21 production and cost guidance update on the 18th of May, and they have lowered their production and increased their costs at one of their mines, Leonora. And one of the reasons they have done that is they have changed their mining contractor to Macmahon, and they are finding it hard to recruit. And this labour shortages has become a problem throughout the mining and mining services industries. So just keep that in the back of your mind if you are thinking of buying a mining or mining services company. Now let's look at the chart for St Barbara. This is the 4-year weekly chart. If we go back to 2018 and 19, we can see a bit of a double top when the share price got to around $5.12 or so. $5 was also reached back in 2007, so that's a sort of a zone where you might think about selling if the share price ever got back up there. And since that top of share price of $5.12 back in early 2019, we've seen the share price go down. Share price bottom out in the COVID-19 financial panic at around $1.80 or just above $1.80. Did rally after the COVID-19 financial panic. In fact, it doubled in price from $1.80 to a top of about $3.80. But ever since that top in August of 2020, the share price has continually gone down. And that did follow the gold prices for a while, but the gold prices have turned around recently, and St Barbara hasn't matched that turnaround, and maybe it's on the back of this financial year 21 production and cost guidance update. Maybe that's why the share price hasn't rallied in recent weeks. However, in saying all that, the share price right now is right at that COVID-19 financial panic low. So we could be seeing a double bottom right now, which could be a low risk buy, because if the share price went below $1.80, that would be automatic sell because that double bottom is no longer at play. But sometimes these double bottoms can be really good buy signals. So keeping my eye on St Barbara for the next few weeks to see if this double bottom is confirmed. Now, is this a buy, a long-term buy and hold sort of company? Well, just like Sandfire, it is not. And just like Sandfire, this is the 15-year monthly chart for St. Barbara. You can see the fluctuations in the share price throughout this period. Way back in 2007, the share price got as high as $5, just like it did in 2018 and 19. So you can just see when I said whenever the share price gets to $5, that's an automatic sell, because right after the share price gets to that level, the share price absolutely tanks. It did it during the GFC, went from $5 all the way to a low of $1.25. Share price during 2013-14 got as low as something like 10 cents or so. I think the company was under stress due to their debt. There were some questions about the viability of the company, but then they solved those viability concerns, and the share price went on a massive run from 2015 through to 2017. A great time to be a shareholder at that point in time. So definitely not the long-term buy and hold. You can hold it for a period of time when the sentiment is quite positive. You could say right now the sentiment is and momentum is quite negative, so that is that at play. But because there is a potential double bottom, maybe you could argue that there could be a shift in the momentum and sentiment in the next few weeks if that double bottom is confirmed. Next company I want to discuss is Structural Monitoring Systems. I'll just call them SMS for now because that's actually what they call themselves. This is a very interesting company, and I might be a little bit biased because I did hold this company for about a year or 2 years back, about 5 or 6 years ago. And the reason I did hold this company was their long-term potential. They've developed CVM sensor tech method for in situ monitoring of cracks in metal structures, i.e. planes. That's why I was excited about them, this whole method of monitoring and detecting cracks in metal structures. They also formed a relationship with this company called Anodyne Electronics Manufacturing, AEM. They are an aerospace product manufacturer. So they developed a relationship with that company in 2012, and then SMS bought AEM in 2017. So they do have revenue, $18.8 million in the trailing 12 months, and they are operational cash flow positive. That's one difference between when I held this company and now. They do have money coming in the door. Back then they didn't. Market cap of only $47 million. So this is really fallen off. I'll show you that in the next slide when I show you the monthly chart. So this is the weekly chart going back again 4 years, and really negative sentiment and momentum in the share price of SMS. So no reason to take a position just yet. I am waiting. I'm keeping my eye on this company. Actually, in fact, I've been keeping my eye on this company for about 3 years or so, just seeing or just watching the share price drop. And the further it drops, the more excited I get. But I just want to see or wait for a shift in sentiment and momentum before I take a position. This is the 15-year monthly chart for SMS. I started taking positions in this company around 2012 and 13, small positions, but I would actually add to my position every few months. One of the reasons I did get interested in this company, not because of what they did, that was one reason, but the other reason was when they did some capital raisings with this particular company, or this investing company, I don't know who they were, the capital raising price was actually higher than the current share price. And every single time you see a capital raising, it's typically the capital raising is done at a discount to the current share price. And I found this really fascinating. If this one company was willing to put money in at a price higher than the current share price, if they're willing to take that chance, I thought that was a good sign they saw potential in this company. I'm wondering now if they're still a holder of SMS. We saw the momentum and sentiment in this company really take off, and towards the end of 2013, share price went from about 25 cents all the way to a high of $2, and actually went to a high of $3 in 2016. And ever since that high in 2016 of $3, the share price has been dropping and dropping and dropping. So definitely negative sentiment and momentum in the share price. I'll just wait for a good consolidation period until I take a position, but I do think this is a potential long-term buy and hold, particularly if they sign some financial agreements with airlines or Airbus and Boeing. If that does happen, we might see the share price take off, with that being a catalyst. Next company I want to talk about is Seven Group Holdings. SGH is not Slater & Gordon, it's Seven Group Holdings. Although the ticker code of Seven Group Holdings is SVW, and the ticker code for Slater and Gordon is SGH. I have been confused by that in recent days. Every single time I go to CommSec and I try to bring up Seven Group Holdings, I put in SGH simply because that is their logo, SGH, and up pops up Slater and Gordon, and then I go, that's right, Seven Group Holdings ticker code is SVW, market cap 7.3 billion, revenue of 4.7 billion, and operational cash flow 621 million. I'd say based off those numbers, not overly expensive, not cheap as well. Seven Group Holdings is a company I completely mistook their activities. I thought this was a mining services company. It's not. It's a diversified investment group. I think the 7-bit is maybe a dead giveaway now. In saying that, they own 20% of Boral, and they're in the process of completely buying Boral out, it seems like, based off a lot of announcements that are popping up lately. So I think Boral management have told their shareholders to take no action in regards to the potential takeover. They also own 100% of Coates Hire, which is an equipment hire company. They also own 100% of Westrac, which own the Caterpillar tractors, 28.5% of Beach Energy, and 40% of Seven West Media. So you can see they're very much a diversified investment group, maybe not as diversified as they could be. Anyway, just based off this 4-year weekly chart, you can see no trend with the share price at all over the past 3 or 4 years. So there's no positive momentum and sentiment right now in the company. I don't believe this is a long-term buy and hold either. So I'd say no for both at this point in time, unless I see any sort of shift in the momentum and sentiment. At this point, no. So no's on all counts with Seven Group Holdings. So fairly short talk in regards to this company, but the chart says all. Unlike Seven Group Holdings, my opinion on Superloop, the next company I'll be featuring, the second last company, is a little bit different. I am a little bit excited about this company, particularly a potential shift in the momentum and sentiment, and I'll talk about the chart in a second. Superloop is a telecommunications company that designed a network, a fiber network through Asia Pacific metro regions. So they have, laid 670 kilometers of fiber networks through Australia, Hong Kong, and Singapore. So right now, this is just my opinion, they've built the infrastructure, so the capital expenditure hopefully should decrease, and I think they're ready to reap the benefits of that massive spend in infrastructure. We'll just have to wait and see. So Superloop's ticker code is SLC, market cap 373 million, revenue 109 million, and they are operational cash flow positive. Now let's look at the chart here. So this is again the 4-year weekly chart, and you can see the share price has been or was in a good long-term downtrend. Share price decreased from about $2.50 all the way to a low of 50 cents during the COVID-19 financial panic. We did see a really nice bounce. But over the past year or so, or since May of 2020, share price has been going sideways. And we can see the 3 moving averages coming together, and the volatility in the share price has been lowering as well. So at this point in time, when we see the lowering in the volatility or the movement in the share price from week to week, when we see the moving averages coming together, we're just waiting for a breakout in the share price. And that's what I'm doing with Superloop right now, is just waiting for that breakout. And if it's a very positive breakout on the back of really good financial news, I'm automatically going to take a position. So I do believe this is a good long-term buy and hold company because they've built the infrastructure. Now they're going to ready to reap the benefits. And I'd say it's neutral momentum and sentiment right now. And I'm just waiting for that momentum and sentiment to become positive, and then we'll get ticks in both, and that's when I'll take a position. Final company I want to talk about today is Snowflake. Unfortunately, you cannot find this on the ASX. You have to look at the New York Stock Exchange or the NASDAQ to find this company. It is probably my most favorite named company in the world, simply because I love snow. I love skiing, and I've lived in places that do get snow, and I've loved those times. just the sound of snow falling, the silence, the serenity, especially when you compare it to rain. Right now it's raining in Brisbane and I can actually hear it even though, it's outside. When it snows, you can't hear it, just this slight little crackle. And then you walk on snow, it's just perfect. Some people hate the cold. I love the cold because you just rug up. You rug up when you go in the snow, and then you come inside and it's warm. And in fact, when I've lived in those snowbound places, it was actually warmer than living in Brisbane because in those places you prepare yourself for the cold. Here, no one cares. Anyway, I'm getting a little bit off topic. Snowflake's ticker code is, well, naturally enough, snow. Market cap $69.5 billion. Woo! It's really up there. So if this was on the ASX, it would be one of the biggest companies listed on our exchange. Revenue $712 million and operating cash flow of only $14.7 million. So instantly your ear should prick up and say, well, this is completely overvalued. But there is a reason why the market cap of this company is really high compared to their financials. And it comes back to the growth of the company. So you always have to look at the growth of the company to justify whether you think a company is overvalued. So here are some numbers in regards to their growth. Revenue has grown at 276% over the past 12 months. And then if you go back to 2018, revenue for that year was $97 million. Now it's $712 million. And that should just show you that the revenue of this company is growing at an extraordinary rate. That's why the market is excited about this company. That's why when this company IPO'd towards the end of 2020, the share price rose 100% on that day. And that's the reason why Berkshire Hathaway, who are typically fairly conservative investors, took a position in this company during the IPO process. And they would be very happy that they actually did take a position. I'm not sure Buffett and Munger made that decision. I think it was some of the other two guys. Anyway, when you look at the chart, that excitement probably was completely priced in when the company IPO'd. We did see a bit of a exponential rise in the share price in November of last year when the share price went from $240 to a top of $400. But the share price has been under pressure during the past 6 or 7 months. Have seen the share price fall from $400 to a low of $190 towards the middle part of May. And that's understandably because a lot of tech companies' share price have been under pressure because of the threat of rising interest rates in the future. So this is a company that is on my radar. Does look like there is potential shift in sentiment in recent days. So I'm going to keep my close eye on this. More than likely, I won't take a position in this company, but who knows, in 5 to 10 years, I could regret not buying into Snowflake. And that is it for this video, this buy, hold, and sell stock starting with S. If you have any questions about these 10 companies or any other company that begins with S, I'd love to answer those questions. And maybe if you thought I made a mistake by not including your company that you love that begins with S, tell me about it in the comment section. Otherwise, I'm not a financial advisor, so these are not recommendations. These are just what I am thinking in regards to my own personal strategies. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.